There are so many ways to make a living in the financial markets, but I only focus on time-tested strategies to generate consistent income, trading options. My strategy is very systematic, almost as if I'm following an SOP, a step-by-step user manual. Here are the key chapters of this video for you to learn a repeatable strategy. First, the basics of option trading, understanding calls, puts, and strike prices. Second, how to choose the right options to trade using the implied volatility, expirations, and the Greeks. Third, my technical analysis techniques for the stock market. Fourth, step-by-step selling put option strategy. 5, profit taking and risk management. And let me remind you, I don't share anything about getting rich quick or making 5 or 6 figures in one trade. Sorry if you're looking for that, but that's not my trading style. I'm Cody Ye, a full-time investor and option trader. I focus on consistency and strategies that are repeatable for a very long time. Perhaps I can rely on them to generate income at home or anywhere I travel for the rest of my life. The first half of the video will consist of crucial fundamentals of option trading. The second half of the video will be my technical analysis and my trading strategy tutorials. Please refer to the timestamps of this video in the description. If you're somewhat familiar with the cash secured put option, you know that this is a time-proven strategy. However, I must emphasize the importance of risk management to you. So I encourage you to finish the video at your own pace. I have been trading this strategy over 6 years and privately mentoring over hundreds of option traders who adopt these two strategies and found success for themselves. All of their testimonials with video recordings are publicly available on my website. I finally compiled all the key concepts and you can watch and learn at your own pace for free. Please give me a free like on this video and save this video to revise the concept whenever you need. Option trading 101. What are stock options? Let me break it down to the simplest definition. Options are financial contracts that give you the right but not the obligation to buy or sell a stock at a specific price before or on a certain day. Think of it as a reservation. Just like reserving a table at a restaurant, you're not required to show up, but you hold the ability to claim that table if you choose to. Now, why would some people want to trade options instead of just buying or selling stocks? The most common reasons are leverage and flexibility. Options allow you to control a large amount of stocks with a much smaller upfront investment, and they can be used for various strategies, from hedging your risk to generating consistent income. But remember, the greater potential returns also come with greater potential risks. So the risk management is critical, as we will cover that in detail later. Now, time to understand the two types of options, call and put. What is call option? A call option gives you the right to buy an asset at a specific price called a strike price before the option expires. If the price of the stock goes up above your strike price, your call options become valuable because it lets you buy the stocks at a discount. Pay attention to this example. Suppose the stock is trading at $50 today and you buy a call options with a strike price of $55, expiring in a month. If the stock price jumped to $60 before your option expires, you can exercise your call option to buy the stock for $55 and instantly have a $5 profit per share. Of course, you can also sell the call option itself for a profit without ever buying the stock. That's the beauty of option. Flexibility. But what if the stock price stays below 55? Then your option expires worthless and you only lose what you pay for the call option, called the premium. No surprises here. The most you can lose with the call option is the premium you pay, not the same as owning the actual stock shares. That leads us to the two crucial basics you must know: premium and stock price. Today, Tesla stock is trading at about $430 per share. We call that the stock price, or price per share for Tesla stock. Now, in options term, the $430 Tesla stock price will be a strike price of an option. A strike price is a fixed price at which you, the owner of the option, can buy or sell the underlying stock. If you own a single Tesla call option with a strike price of $430, that means you can buy Tesla stock at $430 per share. Every option contract represents 100 shares of the underlying stocks. So with 1 unit of call option, you can buy 100 shares of the stocks. So far so good? Please remember to ask me any question that you have in the comment section below. Now that we understand what a strike price is, we want to understand the premium of a call option, which is the cost of buying the option.
Follow this example. On this option chain now, you can see that I have the option calls on the left-hand side with different strike price, like 425, 430, 430, whereas the Tesla stock on the top left corner is showing $441.41. Now, the bid and ask price here, you can see under the calls, are what the buyers and the sellers are offering to pay or sell an option. When there is a deal, meaning the bid and the ask are matched, the premium is formed. So the premium is the price the buyer pay to the seller for the option. For example, the premium for the $430 under a Tesla call option right now is around $38 per contract. If you want to buy it, you're paying this amount multiplied by 100, which is $3,800. Your actual dollar cost of buying a call option is always the premium multiplied by 100.
If you understood the basics of premium and strike price so far, you will find it intuitive to understand the second part of the option. What is a put option? A put option is the opposite of a call. It gives you the right to sell an asset at a specific price, again called a strike price, before the option expires. I like to describe a put option as an insurance policy. If the price of the stock goes down, the put option increases in value because it allows you to sell the stock at a higher price than the market is offering. Again, pay attention to my example. A stock is trading at $50 and you bought a put option with a $45 strike price expiring in 1 month. If the stock price falls to $40, your put option is valuable because you can sell the stock for $45 while it's only worth $40 in the current market. With the flexibility, you don't have to own the stocks. You can sell the option itself for a profit. And just like with the call, if the stock price stays above $45, your option expires worthless. And the only loss is the premium you pay. Let's read a real option chain here.
On the right-hand side, you can see a list of put options at different strike prices. Remember that the strike prices represent the actual stock prices, but not what you're going to pay for these put options. What you pay for is the premium. So here, this $430 put options on the right-hand side has a premium of around $30, which means that you will pay $30 multiplied by 100, $3,000 per put option.
These are the fundamental building blocks of option trading, calls and puts. It took me a while to understand them too, so don't rush it. Take your time to write down some notes for yourself to digest how a call or put works as a financial instrument. Once you understand these concepts, you can start exploring how to use them in strategies like the cash secured put or cover call, which we'll dive into later in this video. Remember, we are building up your knowledge one step at a time to keep things simple and actionable. Understanding the implied volatility, expiration, and the Greeks. Starting from chapter 2, I'll be sharing my personal insights and tips on how to choose the right options to trade and make a profit. In this chapter, we must learn some of the crucial option terminology first to make informed trading decisions. This knowledge is going to differentiate you from the reckless option gamblers and YOLOers who are irresponsible with their money. So what is implied volatility? Implied volatility, or IV, is a key concept in option trading. and is simpler than it sounds. It reflects the market's expectation for how much a stock price might move in the future. Higher IV means the market expects bigger price swings and more uncertainty, while lower IV suggests the stock expected to stay relatively stable. Now, should we interpret the IV to gain advantage as a trader? Let me keep it simple for you. Two key insights. First, high IV is good for sellers, not so good for buyers. Higher IV makes option more expensive because buyers want higher returns. They want something that can move in order to make a profit. So higher IV means more buyers and the premium will go up. Sellers are better off. Second, on the flip side, low IV makes option cheaper, favors buyer over sellers. Whether you're buying or selling option, understanding IV can help you avoid overpaying or underpricing. The implied volatility is a very important concept in option trading. So let me give you a very useful tool, the VIX indicator. How to use the VIX indicator. The VIX, also called the fear index, measures the market's expectation of volatility for the S&P 500 over the next 30 days. When the VIX is high, it usually signals uncertainty or fear in the market, like during major news events or economical crisis. Conversely, a low VIX means the market is calm and the trader expects stability. You can simply look up VIX on any trading platform to see the chart. Some trading platforms like TradingView even let you add the VIX as an indicator on your other stock charts. As traders, how do we read the VIX? A high VIX means that there's a high implied volatility across many stocks in the overall market, making options more expensive. As an option seller, this could be a good time to sell premium. A low VIX, on the other hand, might favor option buyers since premium are generally cheaper. For example, if the VIX spikes after unexpected news, I might shift my focus to selling options, capitalizing on inflated premiums. Next, we will cover the concept of expiration, specifically the expiration date and what is in the money versus out of money. So what is expiration date? Every option contract has an expiration date, which is the last day you can exercise your right to buy or sell the stock. After this date, the option becomes worthless if you haven't exercised it or sold it. Expiration days are critical because they determine how much time value your option has left. The closer it goes to expiration, the faster time erodes the option's value. For this reason, traders who sell options often target shorter expiration days to take advantage of rapid time decay, while buyers may prefer longer expirations for more time to be right. I will explain this further later when we get to Greek letter theta. Let's say you buy an option that expires in 30 days. As the option date approaches, the thing that you care most about is whether you're making a profit or losing money. So this brings us to our next concept, whether the option is in the money or out of the money. What is in the money, ITM, versus out of money, OTM? An option is in the money when it has intrinsic value. For a call option, this happens when the stop price is above the strike price. For a put option, it's when the stop price is below the strike price. In other words, if you exercise an in-the-money option, it will result in immediate profit. An option is out of the money when it has no intrinsic value. For a call option, the stop price is below the strike price. For a put option, the stop price is above the strike price. An out-of-money option might still have value because of time and volatility, but it stays out of money until expiration. It becomes worthless. Let's say Tesla stock is trading at $430. If you own a call option with a strike price of $420, it's in the money because you can buy Tesla at $420 and immediately sell it at $430 and profit a difference of $10 per share. However, if you own a call option with a $460 strike price, it's out of the money because the current stop price is below the strike price. Understanding in the money versus out of the money is critical because it helps you determine the likelihood of your option expiring with value, and this directly impacting your trading strategy. Next, we're moving on to the Greeks, theta and delta. If you have been following my explanation so far, please give me a thumbs up on this video and let me know if my explanation has been clear. What is theta? Now, let me make it clear. Options are decaying assets. They lose value over time. This is because every option has an expiration date. So the theta measures how much the value of an option decreases over time. This is also known as time decay. Every day, as an option loses a little bit of value as it gets closer to expirations. For example, you buy a call option at a cost of $500 and its theta is $5 per day. This means your option loses $5 in value every single day, even if the stock doesn't move. After 10 days, you are down $50 just from the time decay. That's why timing is critical when buying options. Since we are trading these options for short-term capital gains, we can make use of theta both buying or selling options. If you're selling options, theta is your best friend. Every day that passes without the stock moving significantly, the option's value decreases because it's getting closer to expirations. This decrease in value becomes your profit. Think of it like collecting profit over time. If you sell an option for $200 and the time decay reduces its value to $100 by the time you close the trade, you keep the $100 differences as your profit. This means you need to be more precise with your timing. For example, if you buy an option for $200, but the stocks doesn't move as expected and the time decays reduce the option's value to $100. You have lost $100 even though the stock didn't drop significantly. So here's a summary of how to benefit from theta. As a seller, focus on selling options with shorter expiration dates because the time decay accelerates as expiration approaches. This allows you to maximize the benefit of theta and collect the premium faster. As a buyer, only buy options when you expect the price to move significantly within a short period. Consider longer expiration days to give yourself more time, but remember that theta still works against you as the clock ticks. What is delta? Delta measures how much an option price moves for every $1 move in the underlying stock. For call option, delta ranges from 0 to 1, while for a put option it ranges from 0 to -1. Think of delta as your odds of success. A delta of 0.5 means your option has about a 50% chance of being profitable at the expiration. Here's a simple example. You own a call option with a delta of 0.3. If the stock price goes up by $1, your option increases in value by $0.3 per share. Multiply that by 100 shares per contract and your option value increases by $30 for every dollar increase in the share price of the underlying stocks. Let me show you how to interpret delta to gain an advantage as a trader. As a buyer, delta helps you predict your potential gains and choose the right options. If you expect a big move in the stock price, you might pick a lower delta option, for example 0.2 to 0.3, because it's cheaper and the potential return on investment is higher if the moves happen. If you want a safer bet, choose a higher delta option, usually 0.7 to 0.8, because it's more likely to move like the stock and expire in the money. On the other hand, as the seller, delta helps you manage risk by knowing how much exposure your sold options has to do with the underlying stock. If you sell an option with a delta of 0.1, the price won't change much with the $1 move in the stock, making a lower risk. Selling option with a higher delta, for example 0.7, exposes you to more price movement, so it's riskier. A call option with a delta of 0.8 behaves like owning 80 shares of the stock. A put option with a delta of -0.5 behaves like short selling 50 shares. This is important for risk management. For example, if you sell a call option with a delta of 0.6, you're exposed to price moves as if you own 60 shares of the stock. You might offset this risk by buying or selling stocks directly to hedge your position. If the delta seemed like an astronomical concept to you, it's normal. You'll understand it better when we get into the trading strategies. Here's a summary for how we can interpret the delta. For buyers, use delta to pick options that align with your goals. Higher delta for safer bets, a lower delta for high risk and reward. For sellers, use delta to understand your exposure and manage risk effectively. If you're still watching, give yourself credit for learning all of the essential knowledge of option trading. You're now ready to learn a real strategy, as we are going to put all the Greeks and the volatility and expiration day concept together to have a systematic and consistent trading approach. This is a chart for Tesla. In chapter 3, I'm giving you a demo of how I analyze the chart using simple technical analysis techniques. Technical analysis is crucial for traders to understand where the price is most likely heading in the short term and in the long term. Besides, you want to know what are the key price levels that you are going to use to plan your trades.
I only use two indicators to assist my technical analysis. You can add a 50-day simple moving average and a 200-day simple moving average to your chart. Okay, on this chart, the red line is the 50-day moving average and the green line is the 200-day moving average. You can easily go here and add indicator and type in 50 SMA, and I just use this one, 50 SMA, 200 SMA. Okay, and to keep things simple, we just want to identify key support and resistance levels that we can refer to later in our strategy tutorial. Okay, so in terms of the 50-day moving average, the 15-day moving average is a popular technical indicator. It's the average closing price over the last 50 days. Okay, so basically the last 50 days, every single day of the close price, averaging it, we create this line. Okay, the stop price is above the 50-day moving average. The 50-day moving average acts as a really strong support level. Now, when it comes to 200-day moving average, arguably this is one of the most widely used indicator by algos or even human traders. Okay, it's simply the same thing as averaging the last 200 days of close price and created this chart. Okay, this is the strongest support and resistance level. A lot of the time, even during COVID, when it hit the 200-day moving average, it bounced back up a lot. So when we look at this 50-day and 200-day moving average, we want to see the 50-day moving average is above the 200-day moving average. That means the more recent price trend has been moving upwards comparing to the 200 days one. Okay, so in this case, Tesla is showcasing that the stock price is above the 50-day moving average and the 50-day moving average is above the 200 moving average. So it's actually a very good scenario for Tesla right now. Now, we can arguably say that maybe the stock price has gone up way too much and got so much away from the 50-day moving average, might be down, and the stock price might be bound for a retracement. But again, that's another story for another video.
I like to simplify my technical analysis and avoid overthinking, because there are other measures that I like to use to help me improve my probability, rather than over-relying on technical analysis. So are you ready for the step-by-step option strategy tutorial? Let's do a quick stretch if you have been watching this video, and like this video if you're ready to learn the consistent approach. Now that you have learned how to identify the key prices levels using technical analysis, you're ready to learn my option strategy, a very systematic and beginner-friendly approach to trading. Here's my step-by-step guide to sell a cash secured put. A cash secured put is a conservative option strategy that allows you to potentially buy a stock or ETF you like at a lower price while earning income upfront. Yes, you heard me right. You will either earn a profit of your trades as an income or buy a stock at a lower than market price. This systematic approach would be perfect for you if you are also looking to build your long-term investing portfolio while generating short-term income. In other words, you can get the best of the both worlds, collecting short-term gains like traders or buying stocks at an ideal strike price that is below the market price. So how exactly do you make this work? This strategy is possible because you can sell an put option. So the very first prerequisite is to ensure that you are using a broker that allows you to sell puts. I simply use Interactive Broker because it has a beginner-friendly app and low commission for option trading. Now, the definition of cash secure is having the amount of cash to be assigned the shares. If your option gets exercised, recall that earlier I explained that when an option is in the money, you can be assigned the shares at your strike price. If Tesla is trading at $410 and you own a put option with a strike price of $420, the put option is considered in the money. If it's exercised, you will have to buy 100 shares of Tesla stock at $420, which means you are instantly profiting $10 per share in your portfolio. Since this strategy is to sell a put option, which means selling it first and buying it back later, you're also going to make a profit if the stock price goes lower than your strike price. You're collecting premiums. If the Tesla is trading at $430 and you own a put option with a strike price of $420, your option is out of the money. This means it will expire worthless. So if you sold a put option that is out of the money and bought it back at its expiration or before expiration, you can profit from the difference between the premium, which is the price of the put option when you hit sell, and the current premium, which is now lower or closer to $0. Am I making sense to you? Let me know if my explanation has been clear. We're now going to the step-by-step tutorial of this strategy. Step 1, checking the market news and building a watch list of long-term bullish stocks or ETF. You can use any free news website that is recognizable and reliable, such as CNBC and Bloomberg. You want to look for stocks and ETFs that are fundamentally strong and bullish in the next few months or even years to come. Remember, this cash secure put strategy is designed to be a low risk strategy. So make sure you're only focusing on the long-term bullish companies such as Tesla, Apple, Amazon, ETFs such as SPY, QQQ, or other cheaper alternatives. You can also focus on other notable companies that recently report positive news. An example of news that I like to see would be a company recently reported a strong earnings. So now investors are really bullish for the stock. Then you want to add the good stocks and ETF to your watch list. Essentially, the tickers on your watch list are long-term bullish assets that you would also be willing to own and invest long-term, besides the trading them short-term. I'm also updating this watch list and news for my Mastermind program members in our Discord daily news channel. If you're interested in joining my private mentorship, the link to my Mastermind is in the description of this video. Step 2. Look for a dip or pullback among the stocks in your watch list with this cash secure put strategy. The key for choosing what to trade is to find a red ticker that recently dipped or pulled back but still fundamentally strong. This is why having your long-term bullish watch list is very important. You can easily monitor the list of stocks and the ETF on your mobile app and identify which one is in red on the day, meaning that it is traded below its opening price of the day. Step 3, my golden tip, ensuring the volatility of the underlying asset. When you're going to sell a cash secure put option, you want to look for higher volatility, as this indicates higher premium for the options. Think of high premium as your room to profit from the difference between the premium if it expired worthless. The higher the premium is, the more room there is for you to secure a profit. As a part of this systematic strategy, here are 2 simple indicators for you to check. Number 1, the 52-week IV percentile. Implied volatility percentile, also known as IVP, is a statistical measurement that compares an option's current implied volatility, IV, to its historical levels over the past 52 weeks. IVP is expressed as a percentage that ranges from 0 to 100, and a lower IVP indicates that the current IV is low compared to historical levels, while a higher IVP indicates that the current IV is high. IVP is a useful tool for options traders to assess the relative level of IV and identify potential overpriced or underpriced option. My general guide for you is to look for an IVP above 50. If the IVP is below 50, I will avoid trading the underlying stock or ETF. Second, the VIX. Recall that earlier I explained how you can use the volatility index as your trading indicator. In this strategy, the VIX is a straightforward indicator that suggests whether you should trade or avoid forcing any trade. Here's my simplified guide for you. Look at VIX chart and compare the current VIX to the past 3 months. If it's visibly at the lower end, it is telling you that the market is less volatile right now, and the premiums of the options are relatively smaller. In other words, your probability of gaining a profit is smaller. My rule of thumb is, if the VIX is below 20, be more cautious with the option trades that you are planning to take. If the VIX is below 16, I highly recommend avoiding forcing trades. Step 1 to 3 are your basic asset selection criteria that you must know. They are just simple steps to help you choose the right assets and avoid unnecessary losses. Step 4, use technical analysis to find support levels. You can always refer to Chapter 3 again if you need to revise how to do a simple technical analysis and find support levels using the 200 SMA and or the 50 SMA. As identified earlier, the support levels for Tesla are around 360. With the key levels identified, we're going to our next step. Step 5, choosing the best put options on the option chain. This is where you will combine all of the fundamentals of option trading that you learned earlier in this video and choose the put options that will let you gain at least 1% return in a month. Let's look at my mobile option chain here. On the top left corner, Tesla is showcasing it's at the price of $441.60. Okay, and what I'm scrolling around is the expiration date. I mentioned I like to pick an expiration date that's usually within 30 days. But in this case, 32 days looks pretty good, and I will explain why. Okay, now, since Tesla's price is way above the 200-day moving average and way above the 50-day moving average, so I identified the support level to be around $360. Okay, so let's look at how much premium I would get paid. So looking at the bid and ask price of the strike price of 360, I'll get paid around 6.35 or 6.50. Now, if we divide that by $360 that we put in a line to risk for this trade, in case I need to own 100 shares of this stock, it's about roughly a 2%, 1.8 to 2%, right? That says 2% in 32 days. Roughly per year, I'm looking at 24%. That's already doubling the S&P 500 average. I'm happy with that return. And that's above my guidelines of at least 1% capital gain to this option trade. Now, if we look at the delta wise, you guys might think that, Cody, the delta right now is showing negative 0.136. This means there's a 13.6% that might get assigned 100 shares of Tesla at the price of $360, while Tesla is right now at a stock price of $441.63. Okay, so the chance is really low, 13.6%. A lot of you might argue that I can make way more premium by going more aggressive on the delta, but I'm just very conservative and I like to make consistent income. Okay, also if you look at this column of theta, you will see that negative 0.281. That means every day that goes by, I'll be getting paid $28, while this is the amount of money that the put option buyer is losing every day if this
If the stock price continues to stay out of the money, or just don't move at all. So this case, I'm really comfortable with this trade.
Finally, make sure that the premium can generate you at least 1% capital gain through this option trade. In this example that I'm showing you, all these numbers and Greeks might seem overwhelmed to you at first, so I recommend saving this video for yourself to revise the step-by-step criteria of this cash secured put strategy whenever you need. Finally, step 6, sell to open a put option. After going through the first 5 steps, you have planned and identified an ideal option trade for yourself. So here's how I would sell to open a put option with a couple of pro tips that you can follow. By the way, I'm opening a limited slot of one-on-one consultation. It's free for anyone who is serious about learning consistent income option strategy. Feel free to check the link in the description if consistency is what you're looking for. Now, my first pro tip is to set your limited order at the midpoint between the bid and the ask price. This is a simple method to ensure that your order gets executed while lowering the slippage, which is the difference between the order fill price and the market price. Another trick if you're using interactive broker trading app is to turn on price management algo and high display size for better execution. Chapter 5, how to secure your profits and manage your portfolio risks. After opening a trade, your job is to make sure that you take profit. Theoretically speaking, we would like the put option to stay out of the money and worth $0 so that we can collect all of the premium. However, the reality is the price always fluctuates up and down. The worst case you could want is to watch your unrealized profit reach 80% but then retrace all the way back to 0. And you end up being assigned the share, missing out on a decent short-term gain. So here's my strategy to take profit systematically. You can copy my style and treat these as your take profit rules. When the unrealized profit reaches 30% in 1 day, with 50% in 2 days, with 80% before expiration, I will use a give till cancel order to lock in profit at 80% of the premium received. That means I'm setting a stop loss order above my break even that helps me secure at least 80% of my profit if the premium retraces. Now, you must also learn the downside of the cash secured put option strategy and how to manage your potential risk properly. Despite the low risk by the nature of this strategy, you should still learn risk management, especially at a portfolio level. You know that with the cash secure strategy, if the stock price is in the money at expiration, you will be assigned the stocks at the strike price. When assignment happens, your broker will let you purchase the stock at your strike price, which is a discount compared to the current share price of the stock or ETF. So theoretically, the shares that you own should already have unrealized profit. However, what if the share price continues to fall after your assignment? So here are 3 actionable risk management tips for you to minimize your risk and achieve long-term consistency. First, identify a portfolio level stop loss price for the stock or ETF that you would be holding in case of assignment. This price could be a certain percentage loss that you're willing to incur. For example, I only want to be down 20% at max for my QQQ holding, so I will execute a sell order when the unrealized loss reaches 20%. Second, stay informed about market news and trends to protect your portfolio in case of a black swan event. Third, only sell put options on the position that you have money to buy 100 shares of the stocks at any time. We do not want to overextend ourselves during a market crash. It's like what the famous Charlie Munger says, if I know where I'm going to die, I will avoid going there. Ensure you have enough cash to cover the purchase of the stock if you're assigned. Open one contract at a time. This strategy works best when you approach it with a long-term investing mindset. In reality, you won't ever make 5 figures in one trade because you're only opening one put option contract at a time. However, would you rather generate a few hundreds consistently with minimum risks, or approach the stock market with other high risk, high reward strategy? Feel free to share your thoughts with me in the comments section. As a reminder, focus on the long-term bullish assets and fundamentally strong companies if you want to alleviate the stress of holding stocks that are selling off. I hope that this option trading crash course has been useful to you. Please subscribe to this channel if you enjoy realistic stock option content like this. If you're interested in learning more about consistent income option strategy, you can also book a free call with me or my team using the link in the description.